A quick recap from last week. The ECB raised rates by 50 basis points as expected, with Christine Lagarde, president of the ECB, telling everyone stop whining because this was expected. The Swiss National Bank came in and rescued Credit Suisse with a $54 billion injection, allowing them to regroup. Janet Yellen visited the Hill, telling lawmakers that the U.S. banking system has never been stronger and depositors' savings remain safe. 11 of the biggest banks in the U.S. rallied around First Republic, sending in $30 billion in deposits to try and stop the hysteria created over the Silicon Valley banking crisis, right? Sending the message that banking is strong in this country. And just a tidbit, as if nothing else, happy anniversary to the Bear Stearns collapse, which was 15 years to the day on Friday. What we also found out is that Tiger Global makes a move to mark down all the values of their portfolio companies across all of their venture capital funds by 33%, right? And what did stocks do? They remained skittish. They were up, they were down, they were up, and then they were down again. As of Friday morning, the NASDAQ for the week had gained 5%. The S&P was up 3%, the Dow was up 1%, while the Russell was flat. The Fed now expected to raise rates by 25 basis points, as we discussed, and that 1% rate cut by the fall that Fed Fund Future seems to be pricing in, that's not happening. Eco data last week was mixed. The CPI came in hotter, just a bit hotter, while PPI came in substantially lower. Retail sales were down, while housing starts and building permits surged beyond expectations. Friday showed us that industrial production was flat and capacity utilization declined just a bit, and that speaks to part of the inflation story. So you could make a positive out of that if you wanted. Gold rallied nicely last week, trading up to 1968 early Friday morning in a clear move to a safety trade on the back of what is still being perceived as a banking crisis here in the U.S. and in Europe.